Hello there. Welcome back to Account Space. In this video, we want to look at commerce O level, and we are going to look at insurance in particular. So we are going to start by describing exactly what we mean by insurance, and then obviously we are going to also define insurable interest. So we start by insurance. Insurance is described as a contract between a party. Usually, we are saying a contract between a business and the insurance company. We help protect the business from financial loss due to unexpected events. Usually, the unexpected event can be an accident, can be a disaster, or any other unexpected circumstances. So this is the definition that we have in terms of insurance. Then if we move on to insurable interest, on insurable interest, we are saying this is a legal and financial interest in property that would cause a financial loss if it is damaged. So in this sense, we are just trying to say it is the attachment someone has for an asset or a piece of property. So, for example, if you own a car, you can suffer financial loss if the vehicle is damaged or stolen. Therefore, you have insurable interest in the car. So, we are saying if you don't have, if you are not going to enjoy any gain from the ownership of the property or suffer any loss from the ownership of that property, it means you do not have insurable interest. That's exactly what I was trying to have a typical examination question that we want to refer to according to insurance and insurable interest. So this typical examination question is going to help us prepare for upcoming exam. So if you come here, you will see that this is the question that we have. So this is a typical essay question that we have. First part of the question is saying, explain the principle of insurable interest. So we have just explained exactly what we mean by insurable interest, and it's got 4 or 5 marks. Very important for you to take note. So you'll see that explanation that we have here is that first point, the policyholder must gain a benefit from the continued existence of the item being insured or suffer a loss on its destruction. This is exactly as we're trying to point out that for you to have insurable interest, you should be able to suffer a loss from any destruction of that property. So if you don't suffer any loss from destruction of the property, it means you do not have insurable interest, and obviously you do not qualify to insure that property. So there are reasons that are put in place for that scenario that we are just trying to explain here. So second point, prevents a person from insuring the property of another since one has no ownership rights over another's property. So we are saying the issue of insurable interest, we are trying to prevent that a person can insure a property which he or she doesn't own. So that's what we have there. The only last point saying if a person insures someone else's property, they may be tempted to deliberately cause the risk to occur. So these are some of the reasons why we are saying for you to insure, you should have insurable interest. Because if you do not own the property, you might deliberately cause the risk to occur so that you can benefit or make a profit out of that property. So this is what we have in terms of explanation on the principle of insurable interest. So on the second part, it really describes the steps taken to obtain an insurance policy. So when obtaining an insurance policy, these are the steps that has to be followed as you are applying for that insurance policy. First, you have to contact the insurance company. That's the first step. Then you have to discuss the risk to be insured. Obviously, the discussion is taking place between the individual business and the insurance company. Then after that, you have to obtain a quotation in terms of maybe how the payments are going to go about. Then the next step that we have there is to complete a proposal form in utmost good faith. So obviously, we have got a new term that is there that is saying a proposal form. So we want to understand exactly what is the proposal form. But the proposal form, it is sort of a questionnaire that you fill out when applying for insurance coverage. It is also known as the application form. So would also call it an application form. So insurance company use these proposal forms to gather information about applicants to assess the risk of insuring them. So when the insurance company want to maybe assess the applicant of the insurance policy, they can use this form that we are talking about as the proposal form. So this information that they will be obtaining helps them to determine the terms and pricing of the policy. So from the proposal form, that's when they are going to determine the pricing, basing on the information that they obtained. So this is what we have in terms of the proposal form. Then on the next point, the insurance company assess the proposal. So after the proposal has been filled, the insurance company has to assess the proposal. Then next step that we have is the premium is fixed. So our premium is the amount of money paid to insurance companies in exchange for coverage against certain risks. So the amount that is being paid to insurance companies is now the premium. So usually this premium is paid on a regular basis, usually on average monthly, but it can be annually or even fortnightly, depending on the policy terms. So remember, that policy will be having some terms. So depending on the terms, now that's the period of payment is determined. So we go to the next point. We'll see that the next point is saying if cover is accepted, a premium is paid. And then we've got a cover notice issued. And lastly, a policy is later issued. So these are the basic steps that we have in terms of obtaining an insurance policy. So obviously, we also have the next question. This one has got 7 marks, which means the first one is 12 marks. This one is 7 marks to make 12 marks. So we can go to the last part of our question and see what. So on the last point, last question that we have there is a sewing machine valued at $20,000 was insured for $15,000 against the risk of theft. Later, the machine was stolen. Explain why the owner received $15,000 as compensation. So we are saying the sewing machine there is being valued at $20,000. But we are seeing that the money that was paid for the insurance is $15,000, which is less than the value of the asset. So later on, the machine was stolen and the owner received. So the compensation that came was 50,000, which is equal to the money that was paid for the insurance. So the question is, explain why the owner receives 50,000 as compensation. So the question is just trying you to is asking you to explain why the compensation is coming as $15,000 in that way that are being pointed as under insured by 5,000. The machine was valued at 20,000. So if you say $20,000 and then you subtract your $15,000, obviously the answer that you're going to get there is $5,000. So it was underinsured by $5,000, which is correct. And then second point, in accordance with the principle of indemnity. So we would want to understand exactly what you mean by principle of indemnity, because this explanation is trying to say the owner was paid $15,000 because we are complying with the principle of indemnity. So the principle of indemnity, it says that an insurance company will compensate an insured for a loss up to the amount of the loss or the amount agreed upon in the contract. So what was agreed upon is being determined with the amount that was paid for the insurance there, which is $15,000. So you would see that this principle of indemnity is an important part of insurance contracts. It also is designed to protect the insured from losses while preventing them from profiting from them. So basically, we are saying we cannot the person cannot receive an amount that is $15,000 because if the person receives an amount above $15,000, the person is going to make a profit out of it, which is not the case. That is the case that is being disregarded by the principle of indemnity. So we have what points again that are following. So this one is the second point, which is saying in accordance with the principle of indemnity. So basically, we are trying to comply with the principle of indemnity. So on the third point, the owner should be restored to the former position of $15,000, which is exactly as we are explaining. The next one, the insured should not make a profit. So the insured is the one that is paid $15,000 for the insurance. So that person should not benefit or make a profit out of it. So only the insurance company, next point, only the insurance company should make a profit. So that's what we have. Then last point, the owner, yes, his own insurer for $5,000. So the owner was his own insurer for $5,000. So basically we are saying the $5,000 difference that we have here, that's the one that is being referred to as the owner has was his own insurer for that $5,000. So it is not inside the terms and conditions of the insurance that took place. So that's why it's being referred to be on the part of the owner. So this is what we have on the last point. So basically, this is what we have, guys, according to this video. This is a typical examination question. Let's stay tuned for more typical examination questions that are going to be uploaded. As for this video, I'm signing out. Let's meet again in the next video.